While everyone else was jumping from windows during the 1929 crash, I was calmly collecting millions. The market gave clear warning signs months before, signs I recognized because I'd seen them before. In the next 45 minutes, I'll teach you exactly how I spotted the coming collapse when others remained blind to disaster. This single principle of recognizing market tops has saved my fortune multiple times and can protect yours too. I shorted the market heavily in 1929, walking away with over $100 million in today's currency, while the average investor lost everything. Not because I'm smarter, because I respect market patterns that repeat themselves with mathematical precision. The secret isn't complicated. Markets always leave footprints before they collapse. In 1929, I observed volume declining while prices continued rising, a deadly divergence that screams distribution phase. The insiders were quietly selling to eager public buyers who thought stocks only went up. Sound familiar? It should. This pattern repeats in every market bubble throughout history. I've survived and thrived through more market cycles than most traders have been alive. In 1907, I made my first million during the panic. In 1929, I multiplied that fortune. In 1932, I caught the bottom perfectly. Not by guessing, by reading the market's actual behavior. My approach isn't based on hope or economic theories. I don't care about fundamentals when the market is speaking clearly through price action. The tape tells all, if you know how to listen. Most traders fail because they fight the market instead of flowing with it. When the 1929 crash accelerated, brokers were desperately calling clients for more collateral. Meanwhile, I sat in my office watching my profits accumulate, having positioned myself correctly months before. The bloodbath that destroyed others made me wealthy. I'll show you exactly how I identified the distribution phase before the crash, how I measured the market's internal strength failing while prices still looked healthy on the surface, how I sized my positions to maximize profit while controlling risk, and most importantly, how I maintained emotional discipline when everyone else was losing their minds. The market doesn't reward intelligence. It rewards correct positioning and iron discipline. I've made and lost several fortunes throughout my career, but each loss taught me principles that eventually made me one of Wall Street's greatest traders. I've paid millions in tuition to the market to learn these lessons. Today, I'm giving you my most valuable insights without you having to lose a dime. Pay attention. What I'm about to teach you took me decades of trading to understand. I am Jesse Livermore, the boy plunger of Wall Street. I started with nothing, just a poor farm boy from Massachusetts who left home at 14 with barely $5 in my pocket. By 1929, I had amassed a fortune of over $100 million in today's money, shorting the market before the great crash. But my story isn't about luck. It's about a system, a discipline that I developed through brutal trial and error. When I first arrived in Boston in 1891, I found work as a quotation board boy at Payne Weber, earning just $5 a week. I'd watch those numbers change all day, recording stock prices. But I wasn't just writing them down. I was studying them, memorizing them, looking for patterns that others couldn't see. While other boys chatted and wasted time, I filled notebooks with price movements, training my mind to recognize the market's hidden rhythms. By 15, I made my first trade with saved-up money, a profit of $3.12 that might as well have been $1,000 to me. The thrill was indescribable, but I wasn't chasing excitement. I was testing a theory. I'd noticed certain stocks moved in predictable patterns when viewed through the lens of price action alone. At 20, I turned my small stake into $10,000 equivalent to over $300,000 today. I didn't do this with insider information or market manipulation. I did it by developing what I call tape reading, the ability to judge the market's direction purely from price movements. My early bucket shop days taught me discipline. These small gambling parlors took bets against the market, and they hated winners. When they banned me from one shop, I'd wear disguises to trade at others. I was thrown out of every bucket shop in Boston because I kept winning. They called me the boy plunger because of my youth and willingness to make bold market moves. By 1907, I made my first million shorting the market during the panic. I saw the weakness before others did, not because I was smarter, but because I was studying price action while others were reading newspapers and listening to tips. The most important lesson I learned during these early years was this: the market is never wrong. Opinions often are. I don't trade on hope, fear, or rumors. I trade on what the market is actually doing, not what I think it might do. My success came from treating trading as a business, not a game or a hobby. I kept meticulous records of every trade, analyzed my mistakes ruthlessly, and never blamed anyone but myself for losses. This is the foundation that allowed me to rise from poverty to becoming one of Wall Street's greatest traders, and in our time together, I'll show you exactly how I did it. Now let me share with you my most powerful technique, one that made me millions while others lost everything. I call it the pivot line technique, and it's the cornerstone of my trading approach for identifying major market turning points. I developed this strategy after watching the market reverse countless times at specific price levels. These aren't random fluctuations. They're mathematical pivot points where supply and demand forces clash violently. When you recognize these moments, you gain an almost unfair advantage. Let me show you exactly how I identify these pivot lines. First, I look for a stock or market that has been trending strongly in one direction for an extended period. The longer and more extreme the trend, the more powerful the eventual reversal. In 1907, I watched U.S. Steel climb for months before spotting the perfect pivot line to short it. That single trade netted me over $3 million, equivalent to about $90 million today. My pivot line technique requires three specific conditions. First, I need to see price action repeatedly testing a specific level. When a stock hits $50 three times but can't break through, that's not coincidence. That's a pivot line forming. Second, I look for volume patterns that confirm the struggle. Heavy volume at resistance points tells me big money is fighting at that line. Third, I watch for what I call exhaustion moves, those final dramatic price thrusts that trap the last buyers or sellers before reversing. I never simply buy or sell at these pivot lines blindly. Instead, I wait for confirmation, what I call the pivot breach. When U.S. Steel finally broke below its pivot line in 1907, I didn't hesitate. I doubled my position as it fell through that critical level. The beauty of pivot lines is that they work in any market, any time frame. I've used them in stocks, commodities, even currencies. During the panic of 1907, I identified pivot lines across multiple markets simultaneously, allowing me to profit while the financial system nearly collapsed. Remember this: markets don't move in straight lines. They breathe, they pause, they reverse. My pivot line technique isn't about predicting the future. It's about recognizing the mathematical inevitability of market exhaustion. I've refined this technique through decades of trading. In 1929, I used pivot lines to identify the market top before the crash, making $100 million in today's dollars. When others were celebrating new highs, I was quietly positioning for the reversal. The pivot line technique requires discipline. You must be patient enough to wait for the perfect setup, yet decisive enough to act aggressively when confirmation appears. This balance of patience and aggression separated me from ordinary traders. The second pattern I've identified through decades of trading is what I call the rehearsal. Before every major market crash I've traded through, there's almost always a smaller, preliminary decline that serves as a warning shot. I've used this pattern to protect my capital and position myself for enormous profits when the real crash arrives. Let me explain exactly how this works. Markets rarely collapse without warning. In 1929, before the catastrophic October crash that would wipe out 89% of the market's value, there was a significant sell-off in March. I noticed this pattern and positioned accordingly. While others saw the recovery and became complacent, I recognized the rehearsal for what it was, a preview of the devastation to come. I observed this same pattern before the 1987 crash. The market dropped sharply in September, before recovering, only to completely collapse in October. This wasn't coincidence. It was the market's natural rhythm revealing itself to those paying attention. The rehearsal typically exhibits several key characteristics I've learned to identify. First, you'll see unusual volatility in previously stable sectors. Second, market leaders that seemed invincible will suddenly falter. Third, and most importantly, the recovery from this preliminary decline will be unconvincing. Trading volume remains weak despite price recovery. I've developed a specific approach to capitalize on this pattern. When I identify a potential rehearsal, I immediately reduce my long exposure by at least 50%. I then establish small short positions in the weakest sectors, those that fell hardest during the rehearsal and recovered least afterward. This gives me a foothold for when the real decline begins. The critical mistake most traders make is breathing a sigh of relief after the rehearsal decline ends. They convince themselves the danger has passed. I've learned through painful experience that this is precisely when the real danger is beginning. The rehearsal isn't the end of trouble, it's the warning. In 2008, we saw this pattern play out again. The initial tremors in the housing market and Bear Stearns' troubles in 2007 were the rehearsal. The full collapse came months later. I've trained myself to remain vigilant during these seemingly calm periods between the warning and the crash. Remember this: the rehearsal pattern isn't just about predicting doom. It's about recognizing market psychology. Fear appears first as a visitor before moving in permanently. When I see that initial visit, the rehearsal, I know to prepare for fear's extended stay. This pattern has helped me accumulate substantial wealth while others lost everything. It's not about being pessimistic. It's about reading the market's true intentions beneath the surface narrative. I developed counterintuitive positioning after recognizing a critical pattern. When everyone rushes in one direction, the smart money quietly moves the opposite way. During the panic of 1907, I saw this principle work with devastating clarity. While the crowds panicked and sold everything, I methodically built short positions before the crash, then quietly accumulated quality stocks at fire sale prices after the worst had passed. My approach isn't complicated, but it demands iron discipline. When market sentiment reaches extreme euphoria, I look for signs of weakness beneath the surface. In 1907, I noticed credit tightening at banks while stock prices continued climbing. The disconnect was glaring to me, though invisible to most. Trust companies were overextended, Yet the public remained oblivious, continuing to buy at ridiculous valuations. I positioned myself against the crowd by shorting the market heavily before the crash. When the collapse began that October, I was already positioned to profit while others lost. Fortunes. The key insight wasn't some mystical prediction. It was simply reading the indicators others ignored while controlling my emotions. Counterintuitive positioning requires three elements. First, emotional detachment. You must separate yourself from both fear and greed. Second, patience to wait for extreme sentiment. I don't fight small trends. I wait for moments of maximum delusion. Third, conviction to act decisively when the moment arrives. When implementing this strategy, I focus on liquidity above all else. In 1907, I ensured I had cash available when everyone else was desperate for it. This allowed me to buy United States Steel and other quality companies at pennies on the dollar after the crash, multiplying my profits from both directions. The beauty of counterintuitive positioning is its timelessness. Markets have changed dramatically since my day, but human psychology remains identical. The same patterns of fear and greed that drove the 1907 panic drive every market cycle today. I've refined this approach through decades of trading. The critical insight is recognizing that true contrarian trading isn't simply doing the opposite of the crowd. It's identifying precisely when sentiment has reached unsustainable extremes. Most traders attempt contrarian positions too early and get crushed by the prevailing trend. The difference between amateur contrarians and my approach is timing and conviction. I wait patiently for the perfect moment when market psychology reaches maximum distortion, then commit substantial capital with absolute conviction. This is how I turned $1,000 into over $1 million multiple times throughout my career. Pyramiding is how I've made my largest fortunes, not by betting big from the start, but by adding to my winners. Let me explain exactly how I developed this approach in Boston between 1908 and 1915. After my initial success shorting during the panic of 1907, I began refining what would become my signature method. I'd start with a modest position, never risking more than 2% of my capital. When the market confirmed my thesis by moving in my favor, I'd add to the position. Each additional purchase came at a higher price for long positions or lower price for shorts. The beauty of pyramiding is that it's the market itself that funds your increasing exposure. By 1910, I was using the unrealized profits from my initial position to finance the subsequent trades. This meant my risk capital remained largely protected, while my profit potential expanded dramatically. During the bull market of 1908 or 1909, I pyramided into Union Pacific and Reading Railroad. My initial positions were modest, but as these stocks continued their upward trajectory, I added 3 additional tranches. By the time I closed these positions, I'd turned $40,000 into nearly $250,000. The key insight I discovered was the importance of decreasing position size with each addition. My first position might be 100 shares, the second 70, the third 50, and so on. This creates a pyramid structure, hence the name, with your largest exposure at the most favorable prices. In 1915, I applied this method with surgical precision during the war market. As European nations liquidated American securities to finance their war efforts, I built a massive short position in the overall market. Each leg down confirmed my thesis, allowing me to add more shorts at lower prices. This campaign alone netted me over $3 million. But remember this critical rule. I never add to a losing position, ever. That's the amateur's fatal mistake. I only pyramid when the market confirms I'm right. The second rule, I maintain strict position sizing discipline. Each addition must be smaller than the previous one. This prevents overexposure at unfavorable prices. The third rule, I establish predetermined profit targets before initiating the pyramid. Without clear exit criteria, you'll inevitably give back your gains. Pyramiding isn't for everyone. It requires iron discipline and emotional control. Most traders cannot resist the temptation to average down on losers or add excessive size to winners. But for those who master it, pyramiding represents the most powerful method for compounding capital I've ever discovered. It transformed me from a capable speculator into the trader they now call the boy plunger of Wall Street. Let me share one of my most valuable discoveries, pivot line breakouts. I developed this strategy during the Roaring '20s when market psychology became my obsession. From 1921 to 1929, I refined this approach in the New York markets, turning it into a powerful weapon in my trading arsenal. I identify pivot points by looking for significant price levels where the market repeatedly hesitates. These aren't arbitrary numbers. They're psychological battlegrounds where buyers and sellers clash. When price finally breaks through these levels with conviction, that's when I strike. In 1924, I watched U.S. steel consolidate for months around $105. Most traders grew impatient, but I recognized this as a critical pivot forming. When it finally broke above $110 with heavy volume, I established a substantial long position. The stock climbed to $139 before year's end. The pivot break signaled the beginning of a new trend. My approach differs from how most trade breakouts. I don't enter at the first sign of a breakthrough. Instead, I wait for confirmation, usually a strong close above the pivot followed by continued momentum the next day. This patience saved me countless times from false breakouts that trapped overeager traders. I also pay careful attention to volume. A genuine pivot breakout shows expanding volume, clear evidence of institutional money flowing in. Without this volume confirmation, I remain skeptical. During the 1927 bull market, I watched Radio Corporation of America consolidate near $85 for weeks. When it broke through on triple its average volume, I knew this wasn't retail traders. This was smart money, positioning. I followed them in and rode RCA to $114, another crucial element. I always identify my risk point before entering. If a stock breaks a pivot to the upside, the pivot itself becomes my line in the sand. Should price fall back below it, I exit immediately. No exceptions, no rationalizations. This discipline protected me during the 1923 correction, when several promising breakouts failed. I apply the same principles to downside breakdowns. In early 1929, I noticed several market leaders struggling at key support levels. When they broke their pivot points to the downside on heavy volume, I established short positions that would later save me from financial ruin in the crash. Remember this. Pivot points aren't just numbers. They're psychological barriers where market sentiment crystallizes. When these barriers finally break, significant moves often follow. Master this strategy, and you'll position yourself ahead of the crowd rather than chasing after it. I developed the phantom bid method during one of the darkest periods of market history. In 1932, Chicago's trading floors were graveyards of broken dreams, with panic selling driving stocks to pennies on the dollar. While others fled in terror, I recognized something profound. Extreme fear creates predictable behavior patterns you can exploit. The phantom bid method works when markets are in complete capitulation. I'd place small, visible bids slightly below market price, not to buy, but to create the illusion of support. These phantom bids weren't meant to be filled. They were psychological anchors. When I deployed this in Chicago, I watched traders' eyes constantly darting to my bids. They'd hesitate before hitting lower prices, creating artificial support levels. I'd then quietly accumulate my actual position through different brokers at even lower prices. The beauty? My phantom bids cost nothing if done correctly, yet influence the entire market psychology. This method requires precise timing. I only use it when I detect genuine capitulation, when newspapers scream doom, when taxi drivers swear never to buy stocks again, when even veteran traders look physically ill. That's when market participants become most susceptible to psychological manipulation. In one particular instance, United States steel had collapsed from $150 to under $22. The headlines were apocalyptic. I placed visible bids at $21.75 while simultaneously instructing separate brokers to buy aggressively if it touched $21.50. My phantom bid at $21.75 created just enough hesitation among panic sellers that my real orders at $21.50 were never triggered. Instead, the stock stabilized and began climbing. I had effectively created a floor without buying a single share at my displayed bid price. The key psychological insight: during panic, traders desperately search for any sign of stability. My phantom bids provided that illusion, changing the market's trajectory. I must warn you, this strategy carries substantial risk. If truly massive selling materializes, your phantom bids become real positions at prices that could still drop significantly. I've been caught in this trap twice, most painfully in 1929. The method also requires substantial capital behind it to be credible. Small traders attempting this will be crushed. The market quickly identifies and punishes those without the resources to back their positions. Modern markets have evolved, but human psychology remains unchanged. Today's equivalent might be visible limit orders in the order book that create the appearance of support. The principle remains: in moments of extreme fear, strategic illusions can alter market behavior without requiring actual execution. Strategy number 3 is what I call pivot points. This is perhaps my most powerful technique, one that made me millions during the panic of 1907. Pivot points are price levels where the market psychology shifts dramatically. I don't mean simple support and resistance. I'm talking about the exact moments when the entire market sentiment pivots. In October 1907, while J.P. Morgan was desperately trying to save the financial system, I was watching for these pivot points. The market had been declining for months, but I noticed something critical. Certain stocks would reach a price, attempt to bounce, fail, and then accelerate their decline. These failures became my pivot points. I specifically tracked Union Pacific during this period. When it broke below 100 after several failed attempts to hold that level, I knew we were witnessing a pivot point. I shorted heavily. Within days, the stock collapsed to 60. That single trade netted me over $1 million, equivalent to about $30 million today. Here's exactly how I identify pivot points. First, I look for stocks that have made multiple attempts to break through a price level, either up or down. Second, I watch the volume patterns at these levels. Increasing volume on failed attempts signals growing weakness. Third, I wait for confirmation, a decisive move through the pivot that holds for at least 2 trading sessions. The beauty of pivot points is that they work in any market environment. During the 1929 crash, I used the same technique in reverse. After the initial panic selling in October, I identified pivot points, where stocks attempted to break lower but couldn't. RCA created a perfect pivot point at 20. When it held that level for 3 consecutive days, I began accumulating. By 1930, it had doubled. My pivot point strategy requires extreme patience. I might watch a potential pivot develop for weeks before acting. Most traders can't handle this waiting game. They need constant action. I don't. I've learned that the biggest money is made when you identify the exact moment market psychology shifts. Remember, pivot points aren't just technical levels. They're psychological battlegrounds where bulls and bears wage war. Your job is to determine who's winning that war before the rest of the market realizes it. During 1907, I waited patiently for these pivot points across multiple stocks. When they finally appeared, I committed heavily. This is why I made millions while others were wiped out. I wasn't predicting the crash. I was simply responding to the market's own signals at these critical pivot points. Master this strategy, and you'll never need to predict market direction again. The market will tell you everything you need to know. Strategy number 4 brings us to what I call the news reversal method. This approach made me millions during the 1929 market crash when everyone else was losing their shirts. The principle is deceptively simple. When major news hits the market and everyone reacts in one direction, I look for the reversal opportunity. Let me explain exactly how this works. In September 1929, while most traders were still buying into the euphoria, I noticed something critical. Good news was having diminishing effects on stock prices. The market would jump on positive headlines, but the rallies were becoming shorter, weaker. This pattern told me something profound that others missed. I started building my short positions quietly. Not because I had some crystal ball predicting Black Thursday, but because the market's behavior was changing. When good news stops moving prices higher with the same force, it signals exhaustion. I've learned to recognize this pattern across decades of trading. The key to the news reversal method is understanding that markets don't move on news itself. They move on how that news differs from expectations. By October 1929, when the first panic selling began, most traders rushed to liquidate positions at any price. I did the opposite. I had already established my shorts and watched my accounts swell while fortunes evaporated around me. What's remarkable is how consistently this pattern repeats. In 1987, before the crash, I observed the same behavior, diminishing returns on positive economic data. The market had already priced in perfection. When reality couldn't match the fantasy, collapse was inevitable. Here's how you implement this strategy. First, track how markets respond to similar news over time. Are the reactions getting weaker? Second, look for divergence. When good news is met with selling, or bad news with buying. Third, position yourself against the crowd, but only after the initial reaction has played out. Timing is everything with the news reversal method. Enter too early, and the market sentiment will crush you. Enter too late, and the opportunity vanishes. I found the sweet spot is typically 2 to 3 days after major news, when the emotional reaction subsides and reality sets in. This approach requires emotional discipline. During the 1929 crash, I watched friends lose everything because they couldn't separate their emotions from their trading decisions. They bought the dips because stocks seemed cheap, not realizing cheap can always get cheaper. The news reversal method isn't about predicting news. It's about predicting how the market will digest that news after the initial reaction. Master this pattern recognition, and you'll find opportunities others miss completely. The scale-in approach revolutionized my trading in 1921. After a decade of successes and failures, I realized that timing the exact bottom or top of a market was impossible, even for me. Instead of placing my entire position at once, I developed a methodical scaling strategy that protected my capital while maximizing my profits. Here's exactly how I execute it. When I identify a strong trend forming, I enter with only 25% of my intended position size. This initial stake gives me skin in the game while limiting my exposure. If the market moves against me immediately, I've only risked a quarter of my intended capital. In the 1921 commodity markets, I first applied this technique systematically. Cotton prices were collapsing, and I sensed a major bottom forming. Rather than going all in at once, a mistake that had cost me fortunes before, I scaled in gradually. My first position was small. When prices dropped further and confirmed my analysis, I added another 25%. As the trend reversed and momentum built, I added my third portion. Finally, when the uptrend was undeniable, I completed my position. The beauty of scaling in is threefold. First, it reduces the psychological pressure of timing. Second, it improves my average entry price if I'm right about the direction. Third, it dramatically reduces my losses when I'm wrong. I found this approach particularly valuable during market panics. In October 1921, when the market plummeted unexpectedly, most traders either froze or liquidated everything at the worst possible moment. I began scaling in slowly, buying in tranches as others panicked. By the time the recovery began, I held a substantial position at an excellent average price. The discipline required cannot be overstated. You must predetermine your entry points and stick to them religiously. I decide in advance exactly where I'll add each portion of my position, no exceptions, no emotional overrides. One critical rule: I never average down on a losing position unless it was part of my original scale-in plan. Averaging down without a plan is how traders destroy their accounts. I've done it myself and paid dearly for the lesson. The scale-in approach also forces me to think in probabilities rather than certainties. I acknowledge I might be wrong, so I test the waters first. If market action confirms my thesis, I increase exposure. If not, I take my small loss and move on. Remember this: the market provides multiple opportunities to enter a genuine trend. Patience and systematic scaling will serve you better than trying to catch the exact turning point with one massive bet. The market took everything from me in the end, not because it was cruel, but because I betrayed my own rules. By 1940, I had lost my fortune for the third time. I was 63 years old, living in the Sherry Netherland Hotel in New York, surrounded by luxury I could no longer afford. The final crash wasn't in the market. It was in my mind. I want you to understand something profound about trading psychology. Success can destroy you faster than failure. After my greatest triumphs in 1929, I began to believe my own legend. I started breaking every rule I taught others. I averaged down on losing positions. I let emotions drive my decisions. I stopped cutting losses quickly. My bank account reflected this deterioration. From $100 million at my peak, I watched my wealth evaporate until I was $1 million in debt. I'd climb the mountain, fall down, climb again. But this final fall broke something inside me. Let me be clear. Markets don't cause suicides. Psychological demons do. I suffered from clinical depression most of my adult life. In those days, we didn't have names for these conditions nor effective treatments. The constant pressure of trading magnified these internal struggles. When I lost my fortune, I also lost my identity. On November 28, 1940, I walked into the cloakroom of the Sherry Netherland Hotel. I was impeccably dressed as always. Appearance was everything to me. I sat down, wrote a note to my wife calling myself a failure, and ended my life with a single gunshot. This wasn't about money. I'd made and lost fortunes before. This was about a man who could no longer live by his own principles, a trader who had betrayed his trading system. The lesson here isn't about my end, but what led to it. I abandoned the very rules that had made me successful. I stopped cutting losses quickly. I began trading for excitement rather than profit. 3. I ignored market signals that contradicted my opinions. I borrowed heavily against declining assets. I isolated myself from contrary viewpoints. Remember this. Your trading rules aren't just strategies for making money. They're psychological safeguards. When you abandon them, you don't just risk your capital, you risk your mental stability. The market will test not just your methods, but your character. It will offer you 1,000 opportunities to break your own rules. Each time you do, you weaken your psychological foundation. My tragic end wasn't inevitable. Had I maintained the discipline I preached, I might have rebuilt once more. The market didn't defeat me. I defeated myself. My legacy isn't about the money I made and lost. It's about the principles I discovered that still govern markets today. Despite technology transforming trading beyond anything I could have imagined in my era, human psychology, fear, greed, hope, and ignorance remains unchanged. This is why my methods still work in modern markets. I spent decades learning that successful speculation is never about opinions. It's about reading the tape and following what the market tells you. Today's traders have sophisticated charts and algorithms, but they still make the same mistakes I did, fighting the trend, averaging down on losers, taking profits too quickly on winners. The market has taught me humility through devastating losses. I've gone broke several times because I violated my own rules. Each time I rebuilt my fortune by returning to core principles. Never fight the tape. Cut losses quickly. Let profits run. These aren't just catchy phrases. They're survival mechanisms in a game designed to separate you from your money. In today's markets, my approach would remain unchanged. I would still identify the primary trend using price action alone. I would still wait for proper timing before entering positions. I would still manage risk meticulously, never risking more than I could afford to lose on a single trade. The patterns I observed in railroad stocks and commodities a century ago appear in cryptocurrency charts and tech stocks today. The same boom-bust cycles, the same crowd psychology, the same opportunities for those patient enough to wait for the right moment. Markets don't repeat exactly, but they certainly rhyme. My greatest contribution wasn't a specific trading technique, but a philosophy. Trade with the trend, respect the market's message, and protect your capital at all costs. This philosophy has survived wars, depressions, technological revolutions, and regulatory changes. I learned that speculation is not about being right. It's about making money. Being right and making money are often different things. The market can remain irrational longer than you can remain solvent. I discovered this truth through painful experience. The 4 most dangerous words in trading remain. This time, it's different. It never is. New financial instruments emerge, but the underlying dynamics of supply and demand, fear and greed remain constant. This is why studying market history is so valuable. If you take nothing else from my life's work, remember this. The market is always right. Your opinion means nothing. Your ability to adapt means everything. Learn to read the tape, cut losses short, ride winners, and never risk what you cannot afford to lose. Master these principles, and you'll survive where others fail.